Well, good afternoon for another Mortgage Minute with Art Alvarez. And this is post Hillary, the tropical storm. We did see that it did dump a lot of rain in our area, and unfortunately, it affected some of our friends and colleagues, and we wish them the very best. But come rain or shine, no, he's not a mailman. He is Mr. Mortgage Man. That is Art Alvarez. Let's bring Art on. Art, bring us home. What's going on here today?
Hi, Jeff. Yes, I'm definitely not a mailman, but I definitely support your comments about the friends and colleagues we know here in the local area that were affected by the tropical storm or hurricane or whatever they're calling it. It did prove in this local area to be a little more severe, I think, than people anticipated, unfortunately. So.
Well, it's one of those things. It feels like sometimes we, especially here in the Coachella Valley, we get these warnings that some kind of storm is coming and it never happens. And I wonder if we have that whole thing of, somebody crying wolf. And so we take it with a little bit of a grain of salt and then we get caught maybe unprepared.
Yeah, exactly. Although in some cases and in some areas where some of the people we know were affected, I'm not sure there was much they could have done about it. It was just a case that in certain areas, the flooding just sort of overwhelmed particular localized areas that folks really didn't have much they could do about it.
Yeah, I think it's one of those things. I remember a few years back when we had the heavy rains and it put a deluge on the Indian Wells Indian Wells Country Club, and it came so fast and so hard. There was no warning, really. There was nothing they could do, and it sounds like that's how it affected some of our areas for sure.
Yeah, exactly.
Well, let's talk things about mortgage, all things mortgage. I'm going to turn over to you. But before I do, I just want to remind those people watching live, we are here to answer your questions live. If you have any questions, please put them in the chat. That's on YouTube and or Facebook, and we'll send them over to Art, and he will engage and give us an answer. And if you're watching this in a replay, do the same thing. Put them in there, and Art will get back to you. He is Johnny on the spot. He'll make sure to get you an answer because, in mortgage, what do they say?
At Mortgage Works, we have the answers, and they're on the house.
And with that, we're going to turn it over to you. Let's have a great show.
All right. Thanks, Jeff. Well, hello, everyone. Welcome to this week's Mortgage Minute. I'm Art Alvarez at Mortgage Works, where we do have the answers, and they're on the house. So I want to go ahead and get right into it. As you know, we always start the program with giving you a bit of a mortgage rate and bond market update. And what I will tell you is while it was generally a quiet week in terms of economic data, bond yields do remain relatively elevated. And so mortgage rates, sort of in the same vein, are still, I would say, a little bit elevated. We've actually had a little bit of improvement since last week, as you can see by our rate grid on our website. This has been updated to reflect current pricing. It's slightly better than last week. So a little bit of good news in that regard. But when you look at the 10-year bond chart, 10-year T-bond chart, as Jeff will pull up, you can kind of get an idea of what's been going on. You can see the current 10-year bond yield is 4.23. That's actually down from what it was earlier this week and end of last week when we were actually over 4.3. And that did push mortgage rates, particularly conforming mortgage rates as well as jumbo, through the 7% threshold. So in that regard, what did go on this week in terms of economic data? Not really much. Early in the week, there was really very little in the way of economic data that would affect mortgage rates significantly. It was mostly about new home sales and resale home sales. And really in terms of data, not much occurring until today. Although I do want to mention that I think another factor in terms of bond yields being elevated the way they are, at least this week, was because of quite a bit of auction activity going on with Treasury bonds. There was quite a bit of Treasury bonds that went to auction this week. And as you may know, when that happens, when you provide a big increase in supply, sometimes that causes the yields to go up in order to get the bonds sold. So I think that did play a little bit of a factor. In terms of economic data points that came out or are coming out this week, the real significant one started today with initial claims for unemployment, what we call initial jobless claims, as well as durable good orders. Initial jobless claims were actually down a little bit, 230,000 versus 240,000 forecast. And durable good orders were actually down, it sounded like significantly down minus 5.2%. versus 4.0 forecast. But if you peel out the transportation piece of durable good orders, they were actually up 0.5%. And that has to do with the airline industry. The Paris Air Show was in June. That actually typically triggers a lot of orders for passenger jets and so forth. And so as a consequence, there was a drop from June to July. That really explains most of that decrease in durable goods orders. And then tomorrow we have consumer sentiment, which can affect the bond market a little bit. But more importantly, I put in here Powell speaks. That's Jerome Powell, the chairman of the Fed. He is going to be giving a speech at the Jackson Hole Economic Summit tomorrow. I would say keep a close eye on that. When he speaks, people do listen. And depending on what he says, that can psychologically affect the bond market and bond yields. And then, of course, that can trickle down to the mortgage rate. So we'll see what he has to say. If he comments that inflation's not over and the Fed's going to continue to be aggressive, that's probably not going to be helpful in getting these bond yields down. And so mortgage rates may stay elevated. But going back to our rate grid, not that I want Jeff to pull it back up, but just when you go back and look at that, what you'll find is we are in the sixes, very high sixes for conforming loans, about mid sixes for FHA, VA loans. So if you keep hearing 7% is where we're at, that's not quite true. And if you're getting quoted 7% mortgages, either for a purchase or a refi, check with us. We may have a better deal for you. So with that, let's go ahead and get into what I wanted to talk about today. A couple things. The first one being equity lending. And I bring this up. I've talked about it before, but I wanted to talk about it again. And of course, in the header, you can see equity lending, renovations, and debts. So in terms of that, let me give you the backdrop. Of course, the backdrop is the average first mortgage rates right now are now teasing at the 7% level. So first mortgage rates continue to be elevated. This is going to continue that lockup scenario where current homeowners with 2 and 3% rates are just not motivated to move, even if they want to, because they would have to give up that very, very low rate. And by the way, those homeowners, they have an amazing amount of equity right now. If you can believe this, the amount of home equity in the U.S. is now at $30 trillion. Yes, that's with a T. U.S. home equity is at $30 trillion, a very, very high level. And furthermore, in that regard, 49% of homes in the U.S. are deemed to be equity rich. Now, what does equity rich mean? It means that a homeowner has a loan balance that's 50% or less of their home value. So literally half the homes in the U.S. have a loan balance at 50% or less of their value. What does that mean? Of course, they've got lots of equity. Many of those homeowners would like to tap into them. And so what do they tap into their equity for? What is the primary reasons that people get equity loans? Well, there's a couple. But first of all, let me comment, as Jeff just pulled up, equity loans in terms of applications increased 50% in 2022 versus 2 years earlier. And I would argue this year is up even a little bit more further. And then in terms of equity lending, what are these loans used for primarily? As you might guess, about 2/3 of equity loans are obtained for renovation of your home, remodeling your home, adding a kitchen, maybe adding an ADU, those kind of things. So about 2/3 of equity lending involves renovations. Now, the remaining reasons that people get equity loans are for debt consolidation or just to have emergency cash. And with regard to the debt consolidation, that is very common, not the primary, but right behind renovations as a leading reason for getting an equity loan. It's mostly because of credit cards. Credit cards, as of the second quarter of this year, hit $1 trillion in outstanding balances in the U.S., $1 trillion in credit card debt. Not to mention the fact that credit card debt delinquency rates are rising. They're now over 7%. So this is why equity loans, if you're not using them for renovation, the secondary most common reason for the equity lending, the equity loan applications is to get debt consolidation, in particular credit cards. And of course, as I mentioned before, if you're going to go down that path to use an equity loan, whether a HELOC or what I call a HE loan, to consolidate credit card debt, be sure to have a talk with yourself about changing your spending habits to avoid increasing that credit card debt in the future after you've paid it off. So you avoid a situation where you've used up your equity for a temporary reduction in liabilities and then see those liabilities go back up in the future. So you do need to kind of change your behavior when you pursue that strategy. Now, in regard to equity lending, what's happening most recently is we're seeing an increased interest in, again, what I call HE loans. Now, what is a HE loan? A HE loan is a traditional 30-year, well, actually, I should say 10 to 30-year fixed mortgage. But in this case, it's not a first mortgage, it's a second mortgage. Now, with a HE loan, a fixed rate equity loan, a fixed rate second mortgage, you're going to typically get a fixed rate, and then you're going to get the loan, the proceeds, all in one lump sum. It's not like a HELOC where you just draw against it as you wish. When you get a HE loan, a fixed rate second mortgage, you're going to get all the proceeds at once. And of course, when that happens, when you start making your monthly payments, the monthly payments are going to stay the same every month until the loan is paid off. Now, in that regard, why would a fixed rate lump sum proceeds type of an equity loan be of interest to homeowners? Well, what we're seeing is primarily if you've got a big project like a renovation, and it's going to be a big one-time expense, some folks are now looking at a HE loan, a fixed rate second, as the option rather than going with the HELOC. Their thinking being they need that money for one big expense, one big event. In this case, that's not Reno, folks, Reno. That's what we call it in the business. Renovation is also known as Reno, so not Reno. But the idea is if you have a big renovation project, you only need the money for that. You don't intend to use your equity for anything else. A fixed rate second, particularly if you keep the term between 10 and 20 years, can be a very good option for very high credit score borrowers. The interest rates are actually quite attractive. And the other thing to keep in mind about equity loans in general is they're almost always going to offer better rates than unsecured personal loans. So some folks will say, I don't want to get an equity loan. I'll just get a personal loan from my bank or one of the personal loan finance companies. But generally speaking, an equity loan secured by your home is going to have a better rate than unsecured personal loans. And again, don't forget about the possibility when you're getting an equity loan of tax deductibility. Now, of course, ask your tax advisor. I'm not able to give that advice. But if you check, you may find that in most cases, that equity loan that you're contemplating will be tax deductible, another benefit over personal loans. And then overall, I wanted to cover these issues again about equity lending. We still have both HELOCs available and HE loans, under 10% in the case of HELOCs, under 9% in the case of HE loans, fixed rate seconds, for very good, high credit score borrowers who have a lot of equity. So if you're still on the fence about getting an equity loan, whether a HELOC or a fixed rate second, check us out. Be happy to send you some numbers. Got some very good rates, particularly for high credit scores, that you really should take a look at. And by the way, we also have HELOCs and fixed rate seconds for those who are a little bit more credit score challenged. I can actually arrange HELOCs for folks who got credit scores as low as about 620 to 640. And we can also arrange fixed rate seconds and HELOCs for rental property. So keep that in mind. That is somewhat of an underserved area as it relates to equity loans. So if you have a rental property, you'd like to tap into that equity, be happy to quote you some numbers. So that's the update on equity lending. Keep it in mind. It's a very good option, particularly as first mortgage rates continue to be elevated. Now, I want to go over a whole different subject. And again, this is having to do with the fact that, as I've talked before, I tend to keep focus on the news feed as it relates to both real estate and the financial markets, the bond market. And so I saw an article this week that caught my eye that I thought I would talk about. And in fact, here is the title to the article. It says, I have a credit score of 811. Here's why getting a mortgage was still a challenge for me. And this was published on August 21st in a publication called The Ascent. And the basis of this, as it turns out, was the writer of the article was talking about the fact that despite the fact she's got this really high credit score, she's had trouble getting mortgages in the past. And what I learned in the article is what she really wanted to talk about is being self-employed and how difficult it can be to get a loan when you're self-employed. And the kind of the underlying message of the article was that somehow maybe self-employed people are, kind of picked on or not treated as well, or it's just made more difficult for them to get a loan. But I want to kind of cover that because I think there's some myths involved in that. And I'm going to be able to show you in pretty simple terms why self-employed borrowers oftentimes do have a harder time getting a loan. And one of the things she started off in the article was suggesting that self-employed borrowers make lenders nervous because it's harder to prove their income. Well, lenders getting nervous? No, I don't think so. Lenders don't get nervous. What the issue has to do with is, yes, looking at your income when you're self-employed. And of course, when they have to, figure out your income as a self-employed borrower, that does require looking at your tax returns. Now, this writer suggested that the lender has to comb over your tax returns to determine your income. Like that's a really complicated, complex process with a lot of stuff to look at, and then it's a more challenging process. Well, yes and no. Actually, looking at a tax return for purposes of qualifying a borrower is actually pretty straightforward. Now, one of the other things that the writer mentioned is that self-employed borrowers have lower income on paper and must submit more paperwork. Well, again, I get a little bit of a chuckle on that. The more paperwork, yeah, you have to provide your tax returns. Now, if you're a sole proprietor, that just means your last 2 years, 1040 tax returns, your personal tax return. If you're incorporated, it's going to be your 1040 tax returns plus your corporate returns. Most commonly these days is an 1120S, S chapter corporate tax return. So yeah, you do have to provide that additional documentation. It's not that much. It's a couple years tax returns. Now, the comment about lower income on paper, again, I get a chuckle out of that because what's on that paper, that tax return, the lender has to basically accept it as reality, as the truth. And so really what is going on here? Why would it be that a self-employed borrower is going to have a more difficult time getting a loan than a wage earner, somebody that we call them a wage earner? If you're on a salary or you're on an hourly rate working for a company, you're getting a W-2 at the end of the year. Well, the fundamental difference is the idea of gross revenue versus net income. When you're self-employed, you're not going to be qualified based on the gross revenue of your business. You're going to be qualified based on the net income of your business. And you might say, well, gee whiz, if I work for a company on a salary, I'm getting a W-2 that reflects my gross wages. And I understand I'm qualified off of those gross wages. So why is that not true when I'm a self-employed borrower? Well, I'm going to explain that here in just a minute. Now, in that regard, one of the things the writer wrote is that when you're self-employed, your documentation, your tax return is going to reflect all these what she called what she called them tax deductions that wage earners don't have the ability to claim. Well, in reality, her description of tax deductions is a little bit misplaced. When you're self-employed, you're going to claim business expenses against your gross income. Again, business expenses against your gross income. And these for a variety of things, rent, payroll, auto expense, furniture, fixtures, equipment, and so forth. And then that can include some things that are, not really paper expenses like depreciation. So when you're on your tax return, when you're a business owner, you're going to have your gross revenue. You're going to deduct business expenses to get the net income. And the critical point I want to emphasize here is, for qualifying purposes, if you're a wage earner, your gross income, like your gross on your W-2, is equivalent to the self-employed borrower's net income on their tax return. Why is that? Because your wage earner gross income is equivalent to your self-employed net income, because both are basically considered your taxable income. And that makes sense. If you're self-employed, you don't want to get taxed on your gross revenue. That number is way too high. That means your tax hit's going to be way too high. You want to be taxed on your net income and have that be considered your taxable. So in that regard, when you're looking at a wage earner who's got a W-2 with gross earnings, of course, that gross amount goes on the wage earner's tax return, and then you're going to claim itemized or standard deduction from that to get to your taxable income. When you're self-employed, you're going to have your net income go to your personal return if you're a S corp, and then you're going to again take the standard or itemized deductions from that net income figure to arrive at your tax liability. So that's the key difference. You have to realize that when you're self-employed, it's your net income for your business that is being used as your taxable income, just as a wage earner with a W-2 gross, that number is going to be used as their taxable income before deducting either the standard deduction or itemized deduction. So that's the key difference between the two. And so another way to think about it when you're self-employed is if you've got, a business where you've got $500,000 of gross revenue for the year and you've claimed $450,000 of business expenses to have a $50,000 net income. Well, all those itemized expenses on your tax return, the IRS is going to have to assume you've spent that money. Otherwise, you wouldn't be able to claim the expense. And so a lender has to look at it the same way. They can't suddenly say that, oh, those expenses aren't real. Well, you've reported them to the IRS. So the lender has to consider them real. There's no way around that. Now, some limited items, expense items can be reversed, like business use of home, depreciation, amortization, depletion, and those get added back. But in most cases, they're not enough to get that net income high enough to help qualify for the mortgage. Now, the other thing about being self-employed that the writer mentioned was that being self-employed, you're going to be looked at from a issue of stability of income. In fact, the writer even admitted when you're self-employed, your income is going to tend to be less stable. That's just a fact, and that's understandable. And in that regard, what you need to realize when you're qualifying for a mortgage is that that's the reason a lender is going to take a 2-year average of your net income. That means your most recent 2 tax years. They're going to look at both years. They're going to add those net incomes together, add back what expenses they can to get to your average monthly income over that 2-year period. And the reason it's 2 years is to try to get a handle on your stable income over that fairly lengthy period of time. Almost always that 2-year average is going to be what's done. However, you also need to be aware of the 20% rule. If you have a tax return for 2022, you have a tax return for 2021, and if your business shows that the income from your business dropped by 20% or more from 21 to 2022, then that 2-year average will not be done. The lender is only going to use the most recent year. The reason is your business is showing a declining income stream. So in order to establish a stable number, they're not going to do an average where the average is going to include a higher number from 2 years ago when the most recent year has a lower number that's 20% or more lower. Then they're only going to use the current year. So in that regard, it can hurt you a little bit in terms of getting qualified. Now, one other point that the writer mentioned was that oftentimes a business owner will use down payment funds from their business account. In most all cases, that is acceptable. But she was kind of complaining about the problem with that is that you're going to have to write these extensive letters about the impact on your business. Well, that's a reasonable condition that a lender is going to ask you. If you're going to pull business money from your business to buy a home, that's okay. But you've got to provide something, usually a brief letter from your accountant, your CPA, whoever does your tax returns, that money being used for a personal expenditure like buying a home is not going to adversely affect your business. In other words, it's a reassurance to the lender that pulling that money out of your business isn't going to mean your business is going to fail, that you're going to be able to successfully operate it even after you've pulled that money out. So that's the reason for it. It's not really that big a deal to get such a letter. So I wouldn't worry too much about that. Overall, what I wanted to point out here is the fact that the writer wrote this article with all these reasons why a self-employed borrower doesn't get a fair shake in terms of getting qualified. And in reality, that's just not true. Reading a tax return is not that difficult. It's pretty straightforward. And it's really all about the business owner and the decisions they want to make about what's more important to them. minimizing your tax liability or qualifying for a mortgage. If you want to minimize your tax liability as your primary objective, you are going to hurt yourself in qualifying for a mortgage because you're driving down that net income from your business, which is your taxable income. And that's why you're going to run into a problem in getting qualified. The overall point is your credit score alone doesn't get you qualified. Always remember two acronyms in terms of getting qualified: ATR and DTI. ATR is ability to repay. How is that measured? By your debt to income ratio, which means we've got to document your income, calculate that ratio. That's the primary way you're qualified. You do need a good credit score for purposes of eligibility and how well the loan's going to be priced. But a credit score alone is not going to get you approved for that loan, even if you're self-employed or a wage earner. So lastly, the last thing I want to point out about the self-employed borrower then, given these issues that they have to deal with in qualifying, this is probably the primary borrower profile type that the non-QM segment of the market, the non-qualified mortgage segment of the market, is serving. It's serving, in many cases, self-employed borrowers who have very low net income because they're trying to minimize their tax liability. And so the non-QM sector provides them all of the low doc options to get them qualified when their tax returns won't get them there. And those are things like using bank statements to qualify, using 1099s only, or just providing a P&L only. Those are ways that you can get qualified as a self-employed borrower without your tax returns. However, as we've talked before, a little bit of a trade-off because down payment's going to have to be a little bit higher, and the interest rate's going to have to be a little bit higher than a conforming loan. So that's the issue with self-employed borrowers. You're not getting picked on. You're not making lenders nervous. Your income that's on paper, that is your income as you've reported it to the IRS, and the lender has to accept that and work with it accordingly. So just keep that in mind. You're not getting, you're being treated just as fairly as a wage earner borrower. So I just wanted to make that point. Now, going on to our next subject, which actually is the closing question from last week. One of the things I realized in writing this last week for last week's episode is I should have been a little bit more specific as what I was getting at here. And what I was really getting at with this question is gift donors. But here's the question: what are the requirements for a home buyer who wants to use gift funds for their down payment and closing costs? And again, my real point here was to talk about gift donors, what's allowable in terms of getting a gift from somebody to help you buy a home. Well, it depends on whether you're getting an FHA loan or a conventional loan or an FHA loan. These are the two examples I'm going to use. So let's first look at a conforming conventional loan. What is allowable as it relates to acceptable donors? Well, the donors can include the following: a relative, defined as the borrower's spouse, child, other dependent, or by any other individual who is related to the borrower by blood, marriage, adoption, or legal guardianship. Now, you can also have a gift donor who is a non-relative, and that includes a non-relative that shares a familial relationship with the borrower, defined as a domestic partner or a relative of the domestic partner, an individual engaged to marry the borrower, a former relative, or a godparent. And then a third option, as it relates to conforming loans, and this is actually true with FHA too, is, believe it or not, a copy of a wedding invitation to support receipt of gift funds. I bring this up because Realtor.com recently published an article where it's getting very popular for folks who are getting married, that rather than in their registry just asking for all these, kitchen appliances and whatever else they might be asking as wedding gifts, more and more is the case where they're asking for cash donations that they're going to use to save up to for down payment to buy a house. So that is an acceptable source of gift funds. Now, when you go back and look at the relative and non-relative categories, as you can probably anticipate, it can be a little bit challenging to document these kinds of relationships. So we can help you with that. We've got a lot of experience with that. And so oftentimes I can help folks kind of get through that and make sure they're on solid ground as to the source of their down payment coming from gift funds. Now with FHA, what you're going to find is the gift donor requirements is a little bit different. They can include the following: the borrower's family member, of course, that's obvious. And that usually means an immediate family member: brother, sister, mother, dad, grandma, grandpa, that kind of thing. But here's a new one: the borrower's employer or labor union. That's another source for gift funds for an FHA loan. Or FHA also allows a close friend with a clearly defined and documented interest in the borrower. Again, that can be a little tricky to document, but we can help you with that and at least explain to you what they're looking for. A charitable organization can be an acceptable gift donor, or a government agency or governmental agency or public entity that has a program providing home ownership assistance, there's a tongue twister, to low and moderate income families or to first-time homebuyers. So you can see some differences here between FHA and conventional in terms of sources of gift funds and the acceptable donors. Again, if you've got a particularly unique situation, feel free to talk to me, and I can guide you through what's going to work and what's not going to work. One other comment about gift funds, and that has to do with the transferring of gift funds. There's two ways to do it. Quite often when we have a loan in process that's going to involve some gift funds being transferred, the borrower and the donor want to get that transfer done right away, even when we're just starting the loan process and we might be 30 or 45 days away from closing the deal. I always recommend not doing that early. The reason is it creates extra paperwork, and let me explain why that is. For one, we have to document the transfer of the funds from the donor to the borrower. Well, if you do that early in the process, then we've got extra paperwork involved. For one, we have to get a copy of an account statement from the donor to show they already had the money in their possession to provide the gift. So we have to get a copy of their bank statement. And then if the money is transferred to the buyer before the escrow is closed and it goes into the buyer's account, then we have to get another statement for the buyer's account to show that the money was received by the buyer or the borrower. So then we end up with these extra statements in the file. What I recommend is you're always better off in terms of cutting down on paperwork is transfer the gift funds at closing. What I mean by that is the donor would send the money, usually by wire, directly to the settlement agent, to the escrow office, right before closing. That way we don't have to take the additional verification step of verifying and documenting the transfer of the money from the donor's account to the borrower's account, and then have to document the transfer from the borrower's account to the escrow office. You can bypass that middle step by just having the donor deliver the gift funds directly to the settlement agent, directly to the escrow, right before closing. And that's a benefit to the donor too, if you think about it, because then the donor hangs on to their gift funds longer before they have to part with it to give to whoever they're giving the gift funds to. So again, always better transfer the gift funds right before closing. It just allows for less paperwork. So hopefully that helps in terms of if you're going to use gift funds, who you can get the gift funds from, as well as what's the best way to transfer those funds to escrow in order for you to close your purchase. With that concluding, I'll now go on to our closing question for next week. Here is the question. Is it acceptable to get a loan for the down payment? We do get that question asked fairly often. And of course, next week, tune in and I'll have the answer and it'll be on the house. Thank you. Jeff, back to you.
So that's a little bit of a twist from a gift versus a loan. I'm interested in hearing how that all pans out. That that whole gifting thing that got kind of complicated. I was trying to take notes here, and it's got my head spinning. So I might have to have another cup of coffee for this afternoon. But hey, that's why we call you, and you can see Art's number on the screen there, 760-883-5700, or of course you can always call him on his cell phone, 714-612-9035. It is cutting edge. It's probably the latest cell phone out there. It might be the iPhone 15, or actually, I don't know. Do you use a flip the foldable one now?
No, I've got the flip phone. Yeah.
Okay.
Yeah.
The flip phone like they have in Star Trek?
Not quite that. No, it's a more recent model.
Got you. So anyway, you can call Art at 714-612-9035. Of course, you can always go to the website and check and say, hey, what's going on with the rates? That rate grid is up to date. And of course, call or email art at mwloan.com for any other questions. Art, I think that was another great show. Some glimmer of good news in there. I thought that was good. I have a question for you before I let you go. I see that Berkshire Hathaway is really bullish on some of these new home buyers. And then when you say, okay, how does that trickle down to other things? Well, I see that the home improvement stores like Home Depot and Lowe's, they're doing very, very well. And they're saying a lot of people are doing exactly what you're talking about. They're spending a lot of money on renos or renovations. So do we see that as more homes are being built, which, by the way, I was researching after we talked last week, is they're starting to build these homes a little smaller to bring the cost down. And with that, do we see some of these people saying, hey, I can go ahead and go to these, offsite or excuse me, these like HR Horton or something like that, because they do understand this whole idea of buying down the rate to get them into a home. Do you see that starting to kind of, like, if you will, unblock this dam that's being built with homeowners that have these 2 and 3% rates?
Yeah, somewhat. I mean, that's again, I've mentioned this before. The new home industry has always been, I mean, literally for years, decades, have been very good at understanding the role that financing plays in getting their home sold. So the kind of the positive part of the market right now is new home sales, new home construction's up. They're trying to serve that need of lack of inventory in the resale markets. And yes, you're right. At the same time, they're trying to design and build homes that are smaller in order to keep the prices down. In fact, I think I heard that the median price of new homes right now has actually dropped slightly below the median price of resale homes, which is kind of unusual. It's not always been that way. So the combination of them trying to build homes that are smaller, which is actually getting to be more in demand anyway, and then layer into that their home builders being savvy about using financing as a tool, offering credits to apply toward 2-1, 3-2-1 buy downs, pay for closing costs, or both. That is attracting some current homeowners who even do have 2 to 3% low rates. In fact, I have a past customer I've been talking to off and on for the last couple of months who's been kind of back and forth about, should I give up he has a rate under 3. Should I give that up and go buy over here at this new home site? Part of the reason he's looking at that is because there's some very good incentives that the builder's offering to help kind of mitigate that rate differential between what he has now and where the market is.
Does that kind of help both sides? Because all of a sudden now we'll see more resales on the market because, as an example, your customer there, your potential customer there is thinking, hey, I'm ready to move, or I'll make a move because the incentives are so good. And like you talked about last week with the whole deal of what was it, Dave Ramsey's mortgage hack, that we don't even stay in our homes that long. We don't, even though we have a 30-year mortgage, very rarely we will go 30 years. So to me, it feels like that 10-year itch is really starting to cause some angst with some of the homeowners.
I think it is now. Is that happening to a large enough extent that we're going to see a substantial increase in inventory? Probably not. I think we still need some rate relief. We need to see the first mortgage rates, start to settle down. Get back into below 6, hopefully, maybe even get into the low 5s. And what's really interesting is, despite the current levels of bond yields and mortgage rates, Fannie Mae, for example, is still talking about they see a mild recession at the beginning of 2024, and they're still forecasting mortgage rates will be, a hair above 6% by the end of this year. Wow. So, some pretty big players are still looking at there's going to be some relief in the not too distant future. Let's hope they're right.
Yeah, we definitely need that in the housing industry and the mortgage industry as well. Well,
yep.
Hey, as we see on the screen here, his name is Art Alvarez with Mortgage Works. He's here every Thursday giving you the latest in what's going on in the mortgage industry, and then also tips and tactics like he shared today. Great information. Just because you have a high credit score does not mean you automatically get a loan, nor if you're self-employed does not mean you automatically don't qualify for a loan. there's some secrets there that he can help you with. And that's at 760-883-5700 or 714-612-9035 on the flip phone. He'll be manning that, waiting for your call. Art, with that, I'm going to say have a great weekend. Thank you again for all you do. And we'll see you next week on Mortgage Works.
Okay. Thanks, Jeff. Thank you, everyone. Thanks for listening. Thanks for watching. Stay tuned next week for another edition of Mortgage Minute. In the meantime, I'm Art Alvarez at Mortgage Works, where we do have the answers and they're on the house. Take care.